Hey everyone, welcome back to our channel. Today, we're diving into two fundamental models used to value stocks, the dividend growth model and the dividend discount model. These models are essential tools for investors looking to understand the intrinsic value of dividend-paying stocks. So, let's get started. First up is the dividend discount model, or DDM. The DDM is based on the premise that a stock's value is the present value of all its future dividend payments. Essentially, it means that the worth of a stock is determined by the dividends it is expected to pay over time, discounted back to their present value. The basic formula for the DDM is P0 equals D1/RG, where P0 is the current stock price, D1 is the dividend expected in the next year, R is the required rate of return, G is the dividend growth rate. This model works well for companies with a stable and predictable dividend growth rate. Let's go through a quick example. Suppose a company pays an annual dividend of $2 per share, which is expected to grow at 5% per year. If our required rate of return is 10%, we can plug these numbers into our formula. P0 equals $2 asterisk 1 plus 0.05 forward slash 0.10 to 0.05. Calculating this, we get P0 equals $2.10 slash 0.05, which equals $42. This means the intrinsic value of the stock, according to the DDM, is $42. However, the DDM has its limitations. It assumes a constant growth rate in dividends, which might not be realistic for all companies. It also heavily depends on the accuracy of the required rate of return and growth rate estimates. Now, let's talk about the dividend growth model, or DGM. This is a variation of the DDM, often referred to as the Gordon growth model. The DGM also values a stock based on its future dividends, but it specifically assumes that dividends will grow at a constant rate indefinitely. The formula for the DGM is P0 equals D0 asterisk 1 plus G forward slash RG, where P0 is the current stock price, D0 is the most recent dividend payment, G is the constant growth rate of dividends, R is the required rate of return. Let's say a company recently paid a dividend of $3 per share, and we expect this dividend to grow at 4% per year. With a required rate of return of 9%, we can use the DGM to find the stock's value. Calculating this, we get P0 equals $3.12 slash 0.05, which equals $62.40. So, according to the DGM, the intrinsic value of the stock is $62.40. The DGM is particularly useful for valuing mature companies with a stable dividend growth rate. It's simple and straightforward, making it a popular choice among investors. To wrap up, both the dividend discount model and the dividend growth model are powerful tools for valuing dividend-paying stocks. They help investors determine the intrinsic value of a stock based on future dividend payments. However, it's important to remember that these models rely on assumptions about growth rates and required returns, which can introduce uncertainty. Always use these models in conjunction with other valuation methods and thorough research. Thanks for watching. If you found this video helpful, don't forget to like, comment, and subscribe, and hit that notification bell so you never miss an update. See you next time.